right, welcome guys. So you heard a great intro about Kirsten. So I'm just going to kind of jump right into it. So tell us about building Forerunner Ventures, right? It's not your typical venture capital firm. So what were some of the obstacles that you had to overcome in building the firm?
So I've been investing for my career.
I don't think her mic's on. Oh, he's coming.
I'll just talk. I don't know that I'm exceptionally loud, but so as Joy kind of hinted at, I think maybe a little bit of a circuitous route to being in the venture business.
I think he's coming around the back. There we go. Awesome.
All right, better? Okay. So I've been investing for my career. I spent the first 10 years in the public markets. I had a chance to get involved in investing in the retail sector when it was pretty early in kind of what I think of as the last big cycle. It was the time when the real estate industry was populating our landscape with malls, and all kinds of new specialty retail concepts were coming to birth. And it was a really fun time, and sort of the secret to, I think, getting some traction in the space as an investor was identifying what was new and what was up and coming and what had growth opportunities. And then over the course of a 10-year period, like any cycle happens, it played out, and I got to sort of the early 2000 area, and suddenly, it felt like the investment thesis had totally changed. It had moved from growth and opportunity to one of we just put up too many stores across the country. Amazon and eBay became big companies while we were doing that, and now everybody better start closing stores and rationalizing their cost structure. And so as an investor, it was just a much different thesis to be kind of looking at the investment landscape and opportunities through. And it got me starting to think about, well, if one cycle has ended, there must be another cycle on the horizon. And it was a lot more fun being involved in things that were early stage that had a lot of potential in assessing growth. And so I thought, well, I'd like to be part of the next cycle of innovation that happens in the retail and the consumer area. And at that time, it wasn't obvious to me where to go do that. So I left my job, and I thought I would go do a little bit of networking and try to figure out the landscape and find a good firm to work at, hopefully, and start investing in private companies in advance of the next cycle. And I guess a couple of years into it, I sort of realized that I had kind of forged my own territory. Not necessarily that was the plan originally,
right.
But along the way, I met a lot of smart people. I got a lot of input on kind of backgrounds of different investors, different approaches to investing, what it meant to partner with a private company, and I kind of formulated some of my own ideas about that. And at some point, it became something that almost I felt ownership over, and I wanted to do myself. And so in 2006, I started making single investments off of one-off partnerships. We invested anywhere from like $1.5 million to $10 million in individual investment opportunities. Took board seats. That was kind of learning on the job, training. And then by 2009, we were able to put together a first discretionary fund. So it was a bit of a long journey, right. But I think every step along the way was necessary to build some credibility and to have confidence that identified an opportunity that I could step into.
Well, you've accomplished a lot, right? You started from a fund perspective with a $40 million fund, and you have over $100 million under management now. Is that right?
Yeah.
So one of the things I saw, I was reading one of the articles you wrote in Entrepreneur Magazine, and you talked about branding and the importance of branding to companies in this space, and a lot of the investing you do is in the e-commerce space. How do entrepreneurs they have no money, right? I've got no money, I've got anything. How do they actually make a brand, and how important is that to their success?
So kind of my preference, or my strong disposition to back brands, or at least people that intended to build a brand, comes from the basic idea that we live in a world right now where product is pretty ubiquitous. As a consumer, it's good to be a consumer these days. You want something, you can pretty much find it. And similarly, there used to be a game where you could compete on access. Somebody had an exclusive to something, and that gave you an advantage as a company or as a retailer. now, particularly with the internet and everything digital related, it's really open access. You can pretty much get what you want, when you want it, how you want it. And price has never been a particularly good business model to compete on. It tends to be a race for the bottom, and it can, leave you in tricky spots. And so, stepping back from those three things and thinking about where are the opportunities to differentiate. And I really believe that in the consumer industry in particular, it's all about delivering an experience. At the end of the day, this is mostly applicable for the discretionary space. Consumers are emotional people. They're looking to be drawn and attract to something. It's not just about the end item or service that they're getting, but it's about the entire journey, how they're feeling along the way. And I think I saw that early on in my investing career, that if you delivered an experience versus just a product, you had a lot more longevity to that relationship you had with the consumer, which is a really important thing in the consumer space. Like, it's one thing to get a consumer and sell them one thing, but you really, in order to build a business, you really need to be able to get that consumer and sell them 2, 3, 4 things. And so coming from a place of like where you were creating an experience, you were emotionally connecting with them, something about, the entire service that you were delivering had an opportunity to create a connection is really valuable.
So a lot of emotional ROI, right?
A lot of emotional ROI.
So how does that translate into traction, right? And the metrics that you look for from an investment perspective. You've made a lot of investments in e-commerce companies. Are there common denominators there? Are there things that entrepreneurs should look to strive to achieve to make themselves investable?
I mean, obviously at different stages of company building, there are different metrics or different points of traction that are available to you. So starting with kind of the earliest stage, where we tend to invest in, seed stage companies, and sometimes that means there's some level of traction, and sometimes it means it's an idea. And I think that, if I drew out a common denominator at those very earliest stages, it would be founders that are approaching their business from a standpoint of a real connection to the product or service that they're putting out there. So, they have personally felt the need or identified the opportunity for this particular service or item and feel almost compelled, like the only thing they can do is bring this to life. I mean, the reality is when somebody comes in with a very early stage business, it's not a brand. I mean, something is arguably not a brand until you're doing hundreds of millions of dollars of business. But I think there is some certain architecture that you can start out with at the very beginning that lays a foundation that signifies that you have a potential to build a brand. And a lot of it just starts from a point of authenticity and a connection to the consumer and a reason for what you're doing and a true value proposition related to it.
Okay. So to that point, right, so a lot of the brands, we've invested in some brands that have turned out to be really great brands that are well known around the world. How important do you think mobile is, and should it be mobile first now when it comes to e-commerce?
It's a good question. I mean, things are changing so fast, as all of you guys know, being involved in the startup, world. I mean, it's like you changing at warp speed to stay on top of things. Sure. And I think a couple of years ago, even when I made some of the investments that were mentioned in the interview here or the preview here, mobile wasn't something that was terribly important. Today, it's hugely important. It's the primary place where people are checking their devices. So I think that it's a requirement to stay on or ahead of the trend and really in tune with what the consumer is doing. And again, like I said earlier, I think that it is good to be a consumer these days because the consumer is in the driver's seat. They are pushing this revolution forward. And I think that the winning teams are really listening and taking cues from their consumer and are in their heads and are staying in front of that. And so in that framework, mobile is really important. Whether you need to be mobile first or where it fits into your strategy is really dependent on the particular service you're doing.
Okay.
But it needs to be considered.
But it's a critical element.
Yeah.
So in thinking about founders, right, it's very, usually if you've got an idea and your family doesn't think you're completely insane, right, you can get some money to get started from a friends and family perspective.
Yep.
But entrepreneurs have a tendency to struggle after they get that little bit of initial traction before they get to a traditional Series A, right, to an investor round. Mm-hmm. How do they bridge that gap? What are some ways that you've seen companies be able to achieve that and get to that investor round?
I think, just like every element of your business, the fundraising business is a part where you should be, researching and thinking ahead and staying on top of the market and understanding kind of what, where you're going, where you're getting into with that. And so if you've raised a little bit of money, you've communicated to investors what you're going to do with the money, that resonated, they gave you the money, then be thinking about, okay, this gets me how much time, and where are the pools of people that I need to be talking to get the next round of money. Try to start those conversations early. Try to solicit feedback. I mean, in general, I think one of the things I love about this space so much is that it is a collaborative industry. It does work on a village and a community basis, and I think people are willing to share and give information. So I wouldn't be afraid to reach out to an investor, even though you're early, and say, I'm building this company, here's what I'm doing, here's what's special. If I do these things, I'm going to be looking for money. What kinds of things are you going to be looking for? And just collect feedback. You'll get a different answer from every person you talk to, but I think over time you do some of that research and it starts to become clearer to you what it is.
So that's great. So from Forerunner's perspective, right, are there specific metrics that you look for when you're making that decision? I mean, obviously founders are important in that emotional connection, but when you're looking at the other side, right, if we're looking at the metric side, what do you look for to determine if a company is investable?
So if we have the luxury of making an investment after there's some traction already displayed in the market, things that we're looking for are, how is the company finding customers? What is their method for going about and acquiring customers? I think that there's this big trap that a lot of people, can sell a good pitch and have a big story about a big market they're addressing and have, the MBA case laid out and go and raise tons and tons of money and just pay for marketing. I'm kind of, not a believer in that as a good long-term business. I think the good long-term business strategy tied to this whole idea of brand and emotional connection, understanding your consumer, is one where the consumer is excited enough about what you're doing that there's an element of virality for it. And I'm not saying you just, don't spend any money on marketing. Of course, you have to spend money on marketing. But I think, we're looking for something that's resonating with the consumer. We're looking for something where there is a consumer attitude, where you've brought in somebody, you've given them a product, they've interacted with a company, and they can't help but tell somebody else about it, and that's where you get your next sale. So kind of evaluating early on, what is the lower the cost of customer acquisition, just to be really specific, the better, I think, and the bigger the opportunity for there to be a profitable business. I think you also have to start with a margin structure that makes sense. Understand what business you're in, understand what kind of operating costs are going to take to bring it to life, and make sure that you're operating at a level, at a product margin level where it makes sense. A lot of times people have a really great business idea and they're trying to, deliver value. That's something that we all key in on. Value sometimes gets misinterpreted for just price, and they kind of try to compete on price at the sacrifice of margin. And over time, that's a really hard place to be, too. So I think we're looking for something that has a healthy margin structure.
Okay.
Those usually go hand in hand.
True. So in a lot of your portfolio companies, right, they've made some tremendous strides from the time that you made your investment to where they are today. What do you think are the critical factors that help a company go from that 0 to 2 million in that 2 to 5 year window, right? Because you have to show a return to your limited partners as well. So are there common denominators that you see in the companies that have been successful at that?
Yeah, sure. I mean, you guys know you're all in the startup world. It is not easy. And particularly now, we're kind of talking more specifically about companies that have, physical products that you're bringing to life, working capital cycles that you're managing. Then you've got to have sort of the digital place to sell it. You have to have acumen around that, how to acquire a customer, how to get a customer, how to drive a repeat rate on a customer. It's a tall order. But I think that if I look back on some of the companies that we've been fortunate to partner with that have been successful, it's pretty clear there's one common trait that I would attribute to all of them, and that is the ability to empower a team. It's the ability to have a vision that resonates with people, where they feel like they want to be part of it, and they come on board, and they then get supported by the ability to kind of run with their tasks and grow with it.
Okay. So if you were giving advice to an entrepreneur about how to build a successful business, right, and there were 3 things that you could tell them, reversing the table. So, with being the entrepreneur and knowing what you know, what 3 pieces of advice would you give them to build something that becomes an investable business, right, and that's going to succeed long term?
I mean, I don't want to be redundant from what I just said, but I think some of the things were some of the key things. It's really think about your product market fit. What product are you bringing to market? Where does it fit into the landscape? And does the consumer need it? Do they want it? Is it better? And will they pay for it? Hopefully you're not competing on just price. That's not the best long-term place to compete on. Again, I think you want to start with a sound business model. You want to make sure that you've got, appropriate room to run a profitable business. I think, another common trait, I guess I would say, of people that are, I think have been successful is that you almost have this feeling of like, I have to do this. Like, this is what I was meant to do. I can't do anything else because it's hard. It's really hard. And I think if you don't feel that way, you don't feel a personal connection to what you're doing, it's hard. It's easier to give up. And I think you can't give up. You got to have perseverance because most things, I have some companies that I've, been fortunate to be involved in that I think look, from the outside like they just did this. Nothing does that. Everything has its ups and downs, for sure.
So you've also added, right, you started, in a lot of the companies you started investing in early were, e-commerce, B2C companies. But in your portfolio of late, right, you've started to add some companies that are still in that space and some that are social, have a social significance, but that support that infrastructure that's needed for those e-commerce companies. Was that an accident? Was it by design? How did that actually happen?
It's a good question. So it's driven really by two things. So first and foremost, I think, in my journey to build this business or start Forerunner, I always had this attitude of like, well, what does it mean to be a good partner to entrepreneurs? What do I need to do to kind of create some value or be somebody that contributes around the table? Because honestly, like, that's kind of where the fun of it is, And so early on, I was more focused on consumer-facing companies that had products involved because that was kind of where my background and my personal just connection leaned towards. And in an effort to understand those companies and try to do things to add value, I would ask, like, what are you guys struggling with? What's going on? And I would hear some common themes. Trying to figure out this social marketing. How do we measure that? What do we do with this? How do we plan our inventory this way? And so that sort of led me on a path to learning about some of those companies. And while I did that, I became intrigued by their business opportunities. And it was an interesting kind of approach because I already knew what the need was on the client side. And so we started investing in some B2B companies that support some of the e-commerce companies. And then I think, stepping back and thinking more strategically about growing my business, our business, it's good portfolio diversification to have a mix of companies.
Awesome.
And it's nice when you can foster some connection between the portfolio companies and advantages with each other.
To help them be successful.
Yeah.
So I think we got time maybe for one more question. So I'm going to ask something. Is there one thing, if someone's coming to pitch you, because everybody who's got a startup in the room wants to know about pitching a VC, right? Is there one thing that's the kiss of death when they come to pitch you that you would just go like, nope, that's it, I'm done?
You're not going to like this answer, Joy, but no. There's not one thing you can do to just blow yourself up, But I mean, I think that this is going to sound like a very trite answer, but it's just the truth. But I think, being focused and kind of clear about what you're doing and why you're doing it and how you're going to execute at least the next 12 months or 18 months or whatever you're raising money for is really important, because I think that as an investor, it's a dangerous place when you start taking leaps of your own. You're like, I like this, and then if they only do this or that or whatever, you start and like putting your own thoughts and your own fantasies into it, kind of dangerous. You want to make sure that like you're on the same page with the founder, respect the founder's vision, and support the founder's vision to your best of ability. You can have, you can count, I think, hope to build a relationship where you can offer guidance, which may influence things down the road. But I think you really want to kind of start out from a place of where you're connecting on the same thing. And in order to do that, you have to be, as a founder pitching an investor, you have to be clear about what it is you want to do, how you want to do it, why you want to do it.
So clarity is really a big key. That you need to believe that they can accomplish what they're telling you.
Yeah.
Awesome. Hey, I know we're running out of time, so I want to thank you very much for being here, and it's awesome to see somebody who's investing in the early stage companies.
Thank you.
Thank you very much.